in order to keep the system going, they can't let money supply decline. But they've let money supply decline, which tells me the plan is to tank the entire credit system. And that's how you will own nothing. The you'll be happy part, I don't know what they're going to put in the water or the air, but that's how you'll own nothing when credit collapses.
You're watching Silver News Daily. Like this video and subscribe to the channel for the best news that you don't want to miss. Now let's get straight to it.
In today's financial climate, whispers and rumors often shape the future of markets, but every so often, a voice rises above the din with a prediction so audacious, it demands our attention. This is exactly what's happening with David Hunter, a contrarian macro strategist with a track record spanning over 5 decades on Wall Street. Hunter forecasts a historic market melt-up, followed by a significant bust, a roller coaster of financial extremes that could reshape the landscape for investors and commodities alike. But there's one prediction that stands out even more startlingly against the backdrop of his broad market analysis. The price of silver, according to Hunter, isn't just going to rise. It's poised to skyrocket past an almost inconceivable $3,026. Now, why should this prediction hold any weight in a world where forecasts come and go as quickly as the wind changes direction? The reason is David Hunter's unparalleled experience and the depth of analysis that underpins his forecasts. In a career that has weathered countless market cycles, Hunter has developed an uncanny ability to read the undercurrents of the financial world, making his bold proclamation not just a shot in the dark, but a vision grounded in a nuanced understanding of economic dynamics. But how could silver, traditionally seen as a precious yet volatile commodity, reach such unprecedented heights? This isn't just about market optimism or investor speculation. It's about a confluence of factors, including Federal Reserve policies, geopolitical moves, and a shift in investor sentiment that could catalyze a seismic shift in the value of silver. As we delve deeper into this analysis, remember, Hunter's forecast isn't merely a prediction. It's a portal into a potential future where the rules of the financial game may be rewritten entirely. So stay with us as we explore the intricacies of this bold forecast, examining the economic signs, the strategic moves by central banks, and the global dynamics that could turn the silver market on its head. And as we embark on this journey, ask yourself, are we standing on the brink of a financial revolution? Could silver indeed become the beacon of a new era in commodity investment? The answers to these questions might just redefine our understanding of value, wealth, and the very fabric of the market. Don't forget to subscribe to our channel for more insights into this unfolding story, where we decode the signals of the financial world, making the complex accessible. Before we get going, let's take a look at how the government's best and brightest are solving the nation's debt problem. Subscribe to stay up to date on their groundbreaking work.
You know, I'm sure you get the pressure from Brainerd and the Biden administration, their economic policy team, Yellen, et cetera. But I think they're trying to do their job. The problem is, as you get closer to September, the fall, you're going to have to consider that you're right on top of the election. So I think if we're in a place where it's kind of unclear what to do, where you can favor one way or the other, they may sit on their hands in the fall. However, if we get to August, September, and the economy's starting to really unwind, and that could happen, beginning to go the other way, they may have to say, hey, we're going to be accused of being political here, but we got to do what we got to do. Well, on the other hand, if inflation's ticking up and, let's say we've had a strong housing market through the summer and, the market's, as I say, up near 7,000, I think they could tighten in spite of the fact that there's, presidential election in just a few months. Because I think they really worry that if they ignore certain things and the genie gets out of the bottle, it's going to be a lot harder to get it back in there.
As we dive into the second step of our journey, it's crucial to lay the groundwork by understanding who David Hunter is and why his predictions carry so much weight. Imagine a strategist who has not only witnessed but analyzed and navigated over 50 tumultuous years of Wall Street's ups and downs. This is David Hunter, a figure whose career spans half a century of financial markets booms and busts, making him not just a participant in the market's history, but a chronicler of its patterns and shifts. His title as a contrarian macro strategist isn't just a fancy label, it's a testament to his ability to see beyond the immediate, to understand the undercurrents that drive the market in directions others often miss until it's too late. Hunter's prediction of a historic market melt-up, followed by a significant bust, is rooted in a deep understanding of economic cycles, Federal Reserve policies, and the intricate dance between inflation and interest rates. He suggests that we are on the cusp of a seismic shift in the market, a final exuberant surge that defies the cautious whispers of a slowing economy, only to be followed by a correction so profound it could reshape the investment landscape. But it's his bullish scenario for silver and other commodities that draws our focus today. In a world teetering on the edge of economic uncertainty, where traditional investment havens are increasingly questioned, silver shines as a beacon of potential. Hunter's forecast of silver prices catapulting past $3,026 is not merely a speculative leap, but a conclusion drawn from a meticulous analysis of supply-demand dynamics, geopolitical tensions, and a pivotal shift in monetary policies. In this narrative, silver is not just a metal but a symbol of the market's latent potential, a repository of value in a world bracing for change. As we peel back the layers of economic indicators and market sentiment, we invite our viewers to engage in this exploration, to question and debate the feasibility of such a future. Could silver truly reach the heights predicted by Hunter? What are the implications for investors, industries, and economies if such a scenario unfolds? Your thoughts and perspectives are invaluable as we navigate these uncharted waters. Join the conversation in the comments below, and let's delve deeper into this compelling narrative together. And remember, subscribing to our channel ensures you won't miss a beat of this unfolding story, where each twist and turn could reveal new opportunities and challenges in the ever-evolving saga of the financial markets.
With that target, so there's not a, it's not tied to a particular time frame this year, but I think, again, if the bust hits before the end of the year, I think gold tops out pretty much at that point. Or soon thereafter. But so it's a pre-bust target. We did just break out of all-time, to all-time highs. I think we're starting a very big bull market in gold. It's been in a consolidation for several years. We obviously had a big run post-pandemic, March to or April to August of 2020. And it's been kind of trying to move up and out of this consolidation for a while. We've topped out at the highs, 3 times, and we finally pushed through. I'm very bullish gold and the miners that go with it. They're lagging, and obviously a lot of people pretty soured on the miners because they have lagged so badly. But I think they will, as gold moves up, you'll see more and more money come into that space. Same thing with silver. Silver's lagged a lot more than gold. I mean, gold's broken out here. Silver's high is up at 48 maybe, and is currently 24 there, but 24 and change. So there's a long way to go, and basically a doubling just to get back to the highs. I actually think silver is probably going to push to 60 in this move, so pre-bust. And I've said it could even go as high as 75. Once it pushes beyond the highs, we'll see how sharp that move is. And again, the silver miners, same as the gold miners, I think, they've lagged a lot. People are still selling them. You're still seeing it's funny. You're seeing the ETFs in the metals as well as in the miners not get a lot of sponsorship yet. I think people are skeptical, and that's a good sign, from a bull perspective. Longer they wait to really catch that fever, the better.
Delving into the core of our financial saga, it's imperative to understand the monumental shifts marking the end of what David Hunter identifies as a 41-year secular bull market that began in August 1982. This epoch, characterized by unparalleled growth, declining interest rates, and subdued inflation, is on the brink of its grand finale. Hunter posits that we're teetering at the edge of a dramatic turn, a moment in history where the financial landscape as we know it could undergo a profound transformation. The concept of economic cycles, the ebb and flow of market fortunes, isn't new. Yet, the notion that we're at the cusp of such a cycle's climax is both intriguing and daunting. According to Hunter, this isn't merely another fluctuation, it's the precursor to a melt-up, a term that conjures images of a market ablaze with rapid increases in asset values, driven by a confluence of optimism, investor euphoria, and, crucially, policy shifts by the Federal Reserve towards easing. Why does this matter for silver, you might ask? In periods of economic exuberance, as history often shows, precious metals like silver gain a new sheen. They transform from mere commodities to symbols of stability and value preservation amidst the frenzy of market highs. The impending melt-up phase, therefore, isn't just a spectacle of soaring stock prices. It's a harbinger of heightened interest in assets that offer a hedge against the uncertainty of what comes next, the bust. Silver's allure in this context is multifaceted. As a precious metal, it holds intrinsic value that's historically been recognized across cultures and epochs. But its role extends beyond mere adornment or currency. Silver's industrial applications, from electronics to solar panels, imbue it with a demand profile that's both diverse and expanding. This dual nature, as both a hedge and a staple in industrial growth, positions silver uniquely in the narrative of a melt-up, followed by economic recalibration. As Hunter peers into the crystal ball, forecasting a surge in precious metals preceding a significant market correction, it's essential to ponder the implications. A spike in silver prices to the tune of $3,026 would not only signify a monumental shift in investor sentiment, but also underscore the broader economic and geopolitical undercurrents at play. This includes shifts in Federal Reserve policies, geopolitical tensions, and the ever-present specter of inflation. In this unfolding story, silver stands not just as a commodity, but as a protagonist in its own right, emblematic of the broader search for stability and value in a world bracing for change. The anticipation of one last exuberant dance before the music stops invites us to question, prepare, and perhaps position ourselves to navigate the tumult and triumphs that lie ahead. As we continue this exploration, your insights and perspectives enrich the discussion. What do you see as the pivotal factors that could propel silver to such unprecedented heights? How are you positioning yourself in anticipation of the melt-up and the subsequent bust? Share your thoughts in the comments below, and if you're finding value in this deep dive, don't forget to hit that subscribe button for more analysis on where the world of finance might be heading next.
Now, as I say, the pandemic caused a lot of weakness underneath the surface, for what I call fragility underneath the surface. So even though statistically things look much better, and we seemingly are on a normal path, I think, certainly in this country, small business took it on the chin during the pandemic and have only partially recovered from that. Don't forget, for well over a year, I don't remember whether it was almost 2 years, but Walmart and Target were your destinations for shoppers, and small business was told, hey, you can't open. And so, that takes a toll. We lost a lot of businesses, obviously. You're coming back from that, and the way we calculate things, it looks great, or looks pretty good. But underneath the surface, there's still plenty of fragility from companies or small businesses, et cetera, that have some imbalances to work through. Looking at it from a kind of top-down macro perspective, central banks, if I'm right, are not understanding just how long the lag is to inflation. So if they sit here and say, well, we are going to remain pretty restrictive, or at least somewhat restrictive, until we see the actual targets we're looking for, 2% on inflation here and whatever Lagarde's looking for, you're almost guaranteeing you're overstaying your welcome on the tight side. So I think from a monetary standpoint, and I am somewhat of a monetarist, I think you're looking at sometime this year a place where all of a sudden, there's a hiccup in the economy where you can go from seemingly things being pretty good to all of a sudden being surprised that things are rolling over pretty fast.
In the unfolding narrative of our financial epic, the stage is set for a dramatic phenomenon known as the market melt-up phase, a scenario where the markets surge in a rapid and exhilarating ascent. David Hunter's prediction places us at the precipice of this financial spectacle, suggesting a swift, euphoric rally across asset classes, driven by a combination of factors including a significant shift in sentiment among investors and institutions from bearish to bullish, and critically, an end to the Federal Reserve's tightening cycle, transitioning towards easing. The melt-up isn't merely a spike in market optimism, It's a frenzied run-up in asset prices fueled by the fear of missing out, FOMO, speculative investments, and the influx of liquidity into the markets. This phase, as Hunter suggests, could see equities and commodities like silver reaching new zeniths, driven by the potent mix of investor euphoria and strategic shifts in monetary policy. For silver, this environment is akin to fertile ground, ripe for unprecedented growth. As broader market euphoria takes hold, precious metals often emerge as both a beacon for those seeking refuge from the volatility and an opportunity for speculative gains. Why silver, though? The answer lies in its unique position within the financial ecosystem. Silver, with its dual role as both an industrial commodity and a precious metal, stands to benefit from both ends of the economic spectrum. On one hand, its industrial demand, particularly in areas like renewable energy, electronics, and medical applications, provides a steady undercurrent of support. On the other, as a precious metal, silver is historically sought after as a store of value during times of monetary easing and inflationary pressures. As we march towards this melt-up crescendo, the anticipation of the Federal Reserve pivoting towards a more dovish stance, reducing interest rates, and injecting liquidity into the economy, could further catalyze silver's ascent. Lower interest rates diminish the opportunity cost of holding non-yielding assets like silver, making it more attractive to investors. Moreover, the infusion of liquidity and the potential weakening of the dollar could enhance silver's appeal, as it becomes cheaper for investors holding other currencies. This phase, therefore, isn't just about the rise in silver's price. It's a reflection of a broader economic and monetary symphony, with each element, from Fed policies to investor sentiment and industrial demand, playing a crucial part in the crescendo that could see silver prices reaching historic highs. The implications of this melt-up phase are profound, not just for silver, but for the broader investment landscape. It invites a recalibration of strategies, urging investors to consider the potential for both spectacular gains and the volatility that could follow. As we navigate this speculative bubble, the question of timing, of when the music might stop, becomes paramount. In this conversation, we turn to you, our audience, to ponder the implications of this melt-up phase. How are you preparing for the potential volatility and opportunities it presents? And specifically, how does silver fit into your investment narrative as we approach this unprecedented market phase? Share your strategies, thoughts, and questions in the comments below. Remember, subscribing to our channel ensures you stay updated on this journey through the dynamics of the financial markets, providing insights and analyses to guide your path through the tumultuous yet potentially lucrative times ahead.
Gets us 7,000 by this summer, or something particular gets us over 6,000 certainly, and on its way to 7. And the Fed's looking at that. They're looking at housing heating up again. They're looking at the economy still hanging in there, and inflation could be, even if inflation's flat to where we are now, or even down some from here, they may still say, there's just too much speculation in the markets. We see signs in things like copper as a commodity, or housing as an industry, where things are just saying, if we're not careful here, we could have another breakout in inflation. You might see them actually, even if they've already started cutting, go the other way. So let's say that's why I said you could be, next fall, looking at them hiking in the face of an election, not because they're trying to hurt Biden, but because they really say, we don't want to make the mistake we did back in 2022, where we dragged our feet on inflation and thought it was, transitory, and then paid a price. It took us a lot more time here to work it down. We've done all this good work. We have to respond quickly. So I have a scenario where you could actually see the Fed, even like I said, even if they've started cutting, going back the other way and tightening as the economy is starting to roll over. And that would be a recipe for disaster, I think, because, as I said, I think the Fed's been too tight, even though it doesn't show up yet. And then you add to that, further tightness. And again, it probably will be mimicked by the ECB and maybe other banks, so that you could have kind of like the 1930s situation where they should have zigged and they zagged. The Fed should have zigged here and they zagged. So you got the kind of the lagged effect of policy already. And then just when they should be saying the opposite, they tighten. or doing the opposite, they tighten. So if you get that where, you get a temporary, I have a forecast that you could see 2.5% on the 10-year by this summer. You might see it go back from 2.5 to 3.5 or 4 before it, the bus takes it down towards zero. So that you could get that, for several months, a tick up in rates, tick up in things that are restrictive, and then you get the kind of double whammy of the lagged effect of previous policy, along with a very bad reaction here, and down goes the economy, down goes the markets. And the other thing to remember is markets tend to lead. So we could see a top in the market by mid-year or a little after. I tell people I can't. This is what I think is a 41-year top. I can't know which month it's going to top out, so I'm not trying to say it has to happen then. But if it does, let's say top out by this summer, it could roll over, 20-30% in an initial reaction, looking past what the Fed may be looking at. The Fed's focus, as you say, on current data, which is really past data, current data releases, which are telling you what happened, not what's going to happen. The markets are focused on things that are maybe six or 9 months out. And so the market could be part of that beginning of the rollover in the.
As we delve deeper into the impending financial crescendo David Hunter forecasts, it's crucial to understand the pivotal role the Federal Reserve and the dollar's weakness play in shaping the landscape, particularly for silver. This understanding not only sheds light on the mechanics behind the anticipated surge in silver prices, but also offers a broader view of the interconnectedness of global financial policies and commodity markets. The Federal Reserve, the guardian of the U.S. monetary system, finds itself at a crossroads, navigating between the need to stimulate economic growth and the imperative to keep inflation in check. Hunter's prediction posits that we're on the brink of a significant policy shift from the Fed, moving from a tightening regime, characterized by rate hikes and quantitative tightening, to a more accommodative stance, marked by rate cuts and possibly an expansionary monetary policy. This transition is not merely a routine adjustment, but a response to underlying economic currents, and a prelude to what Hunter envisions as a historic market melt-up. Why does this matter for silver? The relationship between the Federal Reserve's policies, the strength of the dollar, and the price of silver is intricate. As the Fed shifts towards easing, it typically leads to a softer dollar, primarily because lower interest rates decrease the yield on dollar-denominated assets, making them less attractive to international investors. A weaker dollar, in turn, makes commodities priced in dollars, like silver, more affordable to investors holding other currencies, potentially driving up demand, and by extension, prices. Moreover, this dovish pivot is anticipated at a time when economic indicators and market sentiment suggest a growing appetite for safe haven assets. Silver, with its dual appeal as both an industrial metal and a precious commodity, stands to benefit significantly. Its value is not only derived from its physical demand in various industries, but also from its status as a store of value in times of monetary easing and economic uncertainty. This is where the dollar's weakness intersects with silver's strength, creating a fertile environment for silver's price to soar as investors seek to hedge against inflation and preserve their purchasing power. As we explore this critical juncture, it's essential to consider the broader implications of these monetary policy shifts. A weaker dollar, while potentially beneficial for commodities like silver, also reflects deeper economic undercurrents that could have far-reaching effects on global trade, debt dynamics, and international relations. The Fed's maneuvers, therefore, are not just domestic policy adjustments but moves that resonate across the global financial system, affecting everything from the price of silver to the balance of economic power. In this intricate dance of monetary policy, currency strength, and commodity prices, silver emerges as a barometer of broader economic health and investor sentiment. Its anticipated rally in the wake of the Fed's policy shift invites us to reflect on the broader implications of these moves, prompting questions about the sustainability of such policies and the potential ripple effects across global markets. As we ponder these dynamics, we encourage you to share your insights and questions. How do you see the Federal Reserve's policy shifts impacting your investment strategy, particularly in commodities like silver? Join the conversation below. And if you're looking for more analysis and insights into navigating these complex financial waters, Make sure to subscribe to our channel.
So some money has been committed, certainly. However, what I think will happen is somewhere in here, the light bulb's going on, and it's like, what am I waiting for? I either get in now or I've missed, this thing. And I think I'm only guessing, but what I think will be part of the narrative will be this idea that soft landing or no landing, we're not going into a hard landing. And so what we're in is the bottom of the cycle, and that there's a new cycle ahead, that we basically barely touched the runway, and now we're off again. And I think once they think, 2025 and 6 and maybe 7 are a new cycle, they're no longer watching their downside. They're saying, hey, I got to get on board. This is early in a new cycle, which is crazy because you're at all-time highs. And what I think also will happen is, I think it'll be very concentrated, because I think the light bulb's going to go off for so many. In other words, we're really in a herd behavior where everybody ran to the wrong side of the boat or ran to the other side of the boat. They've gradually kind of started, there's different people in different places right now, but they're still basically away from the right side of the boat. And I think you're going to see a buying stampede, because I think it'll happen in a matter of weeks and a couple months, where they're all going to say the same thing. Is, that bear story is behind us. What Mike Wilson was telling us is no longer the case. We were waiting for that, but we can't wait any longer, because it's not going to happen. We got to get committed here. And frankly, it's not, this isn't just a trade. This is the beginning of a new cycle. The Fed's done tightening. There's room for, and don't forget, a lot of the economy, in spite of the fact that we haven't had a recession, half the economy, the manufacturing side of the economy, has been in recession. So now, if the Fed's going to be at your back, you can start looking for that to come out of its, doldrums, or out of its downturn, and start, that other part of the market, other than the Magnificent Seven, have a lot of room to run up, because they've been actually underperforming.
As we venture further into the dynamics shaping silver's prospective rally, it becomes crucial to examine silver's intrinsic qualities as a hedge against inflation and economic uncertainty. In a world teetering on the brink of significant monetary easing and geopolitical flux, silver, alongside gold, stands as a bastion for those seeking refuge from the erosion of fiat currency value. This segment delves into why silver, in the context of David Hunter's forecast and the anticipated macroeconomic shifts, could not only surge but also provide a critical safe haven for investors. Silver's allure as a hedge stems from its historical resilience and versatility. Unlike fiat currencies, which are vulnerable to devaluation through inflation and policy changes, silver retains intrinsic value. Its physical scarcity, combined with industrial and monetary uses, underpins its appeal during times of economic uncertainty. As Hunter predicts a melt-up phase driven by exuberant market behavior and subsequent policy easing by the Federal Reserve, the environment becomes ripe for inflationary pressures. In such scenarios, investors traditionally turn to precious metals as stores of value, with silver often seeing increased demand due to its dual role as both an investment and industrial commodity. Furthermore, the expected final run to lower interest rates before a global economic correction amplifies silver's attractiveness. Lower interest rates reduce the opportunity cost of holding non-yielding assets like silver, making it a more appealing investment compared to interest-bearing assets. This shift could funnel more investment into silver, driving up its price as more investors seek to hedge against inflation and preserve their purchasing power in the face of a weakening dollar. In addition to serving as an inflation hedge, silver's extensive industrial applications add another layer to its investment thesis. From electronics and solar panels to medical equipment, silver's demand in various sectors could insulate its value from purely speculative swings, providing a steadier foundation for its price growth. This industrial demand, coupled with investment demand driven by economic uncertainty, creates a potent mix that could propel silver prices to unprecedented levels as forecasted. As we consider silver's role in the broader economic and monetary landscape, it's essential to engage in a dialogue about the strategies investors might employ to navigate these shifting tides. The anticipation of a melt-up, followed by a significant correction, poses both opportunities and risks, with silver positioned as a potentially crucial component of investment portfolios designed to weather the storm. What are your thoughts on silver's role as a hedge in the current economic climate? How are you planning to adjust your investment strategies in light of these predictions and the broader economic indicators at play? Share your insights and questions in the comments below, and let's foster a rich discussion on the ways we can navigate these uncertain times. Remember, for more in-depth analysis and updates on the evolving market landscape, subscribing to our channel ensures you stay informed and ahead of the curve.
The problem is people have a narrative, and if he's not saying what they want him to say, they criticize him, and yet they ought to look in the mirror. So at least, like I said, up till now, he's right. And what I give him credit for, to my side of things, is he's not getting caught up in the month-to-month number and say, oh, we're up a tick. We've got to now we're going back to the tight side, or we're beginning to. He basically has held the course. Some of his other members on the committee kind of bounce around, but he's held the course and said, we're not ready to cut yet, but we think cutting is coming this year. And I think that's exactly. Yesterday didn't change that, I don't think.
As we navigate through the labyrinth of economic indicators and monetary policies, the anticipated shift towards lower interest rates emerges as a pivotal moment with far-reaching implications, particularly for silver. This step delves into the nuanced relationship between interest rates, their impact on investment landscapes, and why a decrease in these rates could significantly enhance silver's appeal to investors. In the grand tapestry of financial markets, interest rates act as the threads that weave through every investment decision, influencing the cost of borrowing, the yield on savings, and the overall economic growth. As we stand on the cusp of what David Hunter forecasts as a dramatic policy shift towards easing, the landscape is set to undergo a profound transformation. Lower interest rates historically have a domino effect on the economy, spurring borrowing and investment, but also diminishing the yield on traditional interest-bearing assets. For silver, this environment is akin to fertile ground. The reason is twofold. Firstly, lower interest rates reduce the opportunity cost of holding non-yielding assets. When bank deposits and bonds offer minimal returns, the allure of precious metals, including silver, shines brighter. Investors, in their quest for value, often turn to these tangible assets not just for potential price appreciation, but as a hedge against the volatility of more speculative ventures. Secondly, silver's intrinsic value, derived from both its industrial demand and monetary heritage, positions it uniquely at the intersection of the tangible and financial worlds. As interest rates dip, the broader economy benefits from increased liquidity, stimulating growth, and by extension, industrial demand for silver. This dynamic, coupled with silver's role as a safe haven during times of economic uncertainty, creates a potent catalyst for price appreciation. Moreover, the backdrop against which these interest rate decisions are made is crucial. The Federal Reserve's pivot towards easing, in anticipation of economic headwinds, underscores a broader strategy to preemptively cushion the economy. In this strategic maneuvering, silver stands out not merely as an investment option, but as a barometer for investor sentiment and economic health. The implications of these shifting tides are profound, urging investors to recalibrate their portfolios in anticipation of the changing yield landscape. Silver, with its dual appeal, offers a path not only for potential gains, but for diversification and protection against inflation and currency devaluation. As we contemplate the upcoming shifts in monetary policy and the ramifications, it's essential to consider how these elements influence our investment strategies and perspectives on assets like silver. The conversation around these topics is rich and multifaceted, inviting a diverse range of insights and strategies. How are you preparing for the potential changes in interest rates and their impact on your investment choices, particularly concerning silver and other precious metals? Share your thoughts, strategies, and questions in the comments below, fostering a dialogue that helps us navigate these complex financial landscapes together. And for ongoing analysis and insights into the evolving economic and investment climate, remember to subscribe to our channel, ensuring you stay informed and ahead in the investment game.
That the weakness that everybody thought was coming, including me, has been somewhat postponed. There's weakness in the economy in certain sectors, but the overall economy has been surprisingly resilient. So, we're chugging along. Soft landing seems to be gaining more and more traction, and the Fed's sitting here looking pretty good because you've got so-called economy that's not dipping into recession, and inflation, despite yesterday's number, still trending down. So they've they've caught a lot of flack for being too aggressive on hiking, or from other people not hiking fast enough. And yet they're kind of, they look like, the porridge is just right. They've
As we delve deeper into the intricate dance of global economics and its implications for silver, it's essential to consider the broader picture, particularly the role of global economic conditions and uncertainty. In a world where geopolitical tensions simmer and economic policies shift like sand underfoot, the allure of silver becomes increasingly pronounced, not just as a commodity, but as a beacon of stability in tumultuous times. The global economy is a vast and interconnected web, where ships in one region can send ripples across continents. With the Federal Reserve's anticipated move towards lower interest rates and the consequent weakening of the dollar, we find ourselves at a juncture that could redefine the appeal of silver on the world stage. A weaker dollar typically makes dollar-denominated commodities like silver more accessible to investors holding other currencies, potentially driving up demand, and with it, prices. However, the story doesn't end there. Global economic conditions, from the pace of growth in major economies like China and the European Union to trade negotiations and geopolitical conflicts, play a crucial role in shaping investor sentiment. In times of uncertainty, whether due to economic downturns, political instability, or even pandemic fears, investors often seek refuge in assets that have stood the test of time as stores of value. Silver, with its millennia-long history as a medium of exchange and value preservation, naturally comes to the fore. Moreover, the industrial demand for silver, buoyed by its applications in electronics, solar energy, and medical technologies, adds a layer of complexity to its role as an investment. Even as investors flock to silver as a safe haven, its industrial use ensures a baseline demand that can support its price even in the face of speculative fluctuations. The anticipated global economic conditions and uncertainty present a dual-edged sword for silver. On one side, increased industrial demand and investment appeal could propel prices to new heights as predicted. On the other, any significant improvement in global economic stability or a resolution to geopolitical tensions could temper investor enthusiasm for safe haven assets, potentially moderating silver's rally. As we navigate this labyrinth of economic indicators, monetary policies, and geopolitical tensions, the narrative around silver becomes ever more compelling. It stands not just as a commodity to be traded, but as a reflection of the world's economic and political health, a mirror to the hopes and fears of investors globally. What's your perspective on how global economic conditions and uncertainty will shape the future of silver? Do you see it continuing to rise as a haven amid turmoil, or do you anticipate a different trajectory as the world navigates these uncertain times? Share your insights and analyses in the comments below. Engaging in this dialogue not only enriches our collective understanding, but helps us all to make more informed decisions in the complex world of commodity investments. Remember, for more deep dives into the dynamics of the financial markets and the factors driving commodities like silver, make sure to subscribe to our channel. Stay informed and stay ahead in the ever-evolving narrative of global economics.
And first of all, if you listen to Powell and look at what the Fed's doing, they're saying we feel like the economy is not going into recession, but we feel like we've made a lot of progress on inflation. And so we think we may be able to cut in spite of the fact that we're not looking for a recession. So everybody's got this black and white thing. If the Fed cuts, it means we're heading for disaster. If the Fed doesn't cut, it means the economy is okay. They're looking at, they have two mandates. One is the economy and one is inflation. I just don't believe that a rate cut is the beginning of it. As I've said many times, my melt-up call does not count on Fed cuts. So I'm not saying that Fed cuts are the reason we're going to get a melt-up. On the other hand, I don't think rate cuts signal a top in the market. It's later on when you get, sustained rate cuts because it's very obvious the economy is rolling over like you saw in 2008. That's when, yes, rate cuts are not a bullish thing. But I'm looking at the bond market. The bond market, if the Fed stood here and didn't cut at all, I'd still be saying 7,000 on the S&P because the bond market's moving ahead of the Fed. The Fed is a group of policymakers making a judgment on the economy, just like every other economist and strategist out there. they're human beings, and frankly, they're government bureaucrats to some extent, and not necessarily market savvy people. So they can be very slow to make changes. I'm not sitting around saying the market's going to wait for that. The market's smart enough to see things themselves. I think the market's a much better forecaster than any one of the people sitting in the FOMC. I do believe they're probably going to be cutting here, by before mid-year. But I'm not worried about whether they do or don't, and I'm certainly not saying the end of a market top is signaled by their cut, particularly if it's 0.25% or even 0.5%. It's when you start seeing them, saying we've got to cut a lot more aggressively. You'll have already known, I think,
as we journey deeper into the financial narrative shaping the future of silver, it's pivotal to understand investor behavior and demand dynamics. Amid the swirling currents of economic indicators, Federal Reserve policies, and global uncertainty, the role of investor sentiment in driving the price of silver cannot be overstated. This segment illuminates the psychological and market forces propelling investor interest towards silver, particularly in a landscape marked by unprecedented monetary easing and geopolitical complexities. In the realm of investment, sentiment often precedes reality, shaping market movements and asset valuations. As David Hunter forecasts a historic market melt-up, followed by a significant correction, the allure of silver intensifies, not merely as a physical asset, but as a symbol of security and prosperity amid volatility. The rationale behind this growing interest is twofold: the search for safe havens and the speculative allure fueled by the prospect of rising prices. Investor behavior, especially in times of economic uncertainty, leans towards assets perceived as stores of value. Silver, with its historic monetary role and inherent value, fits this criterion perfectly. The anticipation of lower interest rates and the potential for a weaker dollar further enhances silver's attractiveness. As traditional yield-bearing investments lose their sheen in a low-interest rate environment, the relative appeal of non-yielding assets like silver increases. Investors, driven by a mix of fear and opportunity, increasingly view silver not just as a hedge against inflation, but as a key component of a diversified investment portfolio. Moreover, the speculative dimension of investor behavior plays a critical role in silver's demand dynamics. The prospect of significant price appreciation, as suggested by Hunter's predictions, acts as a magnet for speculative capital. This influx of speculative interest can amplify price movements, creating a self-reinforcing cycle of rising demand and escalating prices. However, this speculative interest also introduces volatility, making the journey of silver prices a potentially tumultuous one. In addition to these factors, the evolving landscape of digital and social media has transformed the way information and sentiment spread among investors. News, analyses, and forecasts, whether bullish or bearish, circulate at unprecedented speeds, influencing investor decisions.
Yeah, I said back in early November, when we had those first big days out of the market dropped from 4,600 to 4,100, just below 4,100 in late October. And then we had that next week, we had 3 or 4 very big days. And I said, we were in the bull leg. I was calling it a bull leg from October of 2022, the bottom, and all the way up to 4,600 when we corrected, and then came out of that 4,100 level with the kind of oomph we had. I said, it looks to me like the melt-up portion of this bull leg has begun. And I still stand by that look what happened in November, December. It clearly to me was, what I expect in a melt-up is a steeper, more dramatic rally is what I would call it. And then it moves into, from melt-up, it moves into parabolic melt-up, which will be the final phase. We're not there yet, but we are in melt-up, in my opinion. There's two.
Is it greed?
Well, certainly greed's a part of it, and is in every big rally. But what I think are the two components that are most that are causing this. One is, as I said before, the bigger picture, not right now, but the bigger picture of sentiment was that everybody got on one side of the boat. The retail was bearish, but even more so, institutions, one after another, told you why this market had to go down and why they were cautious. That obviously momentum in the tape, what I call momentum of the tape, ultimately moves people away from that extreme view of bearishness. But if you just watch CNBC and the people that come out one after another, they're still skeptical of this rally. They're still positioned defensively because they think there's, at the very worst, they may have abandoned their calls for 3,200 or sub 3,000, but some still are there. But many of them still believe we've got to have at least a 10 or 15% pullback here. This is crazy. So they're all kind of defensively positioned or less than fully bullishly positioned, waiting for that entry point that I don't think is going to come. And as a result, and particularly now that you're moving to new highs, I think pretty soon it's probably going to have to push through 5,000 and keep going. But at that point, I think they're going to abandon that, cautiousness and say, hey, we can't wait any longer. This thing's got legs. That I think is a part of it. And then the other big part of it is we can spend all the time we want. And this is what Wall Street and the social and the outlets like CNBC and Bloomberg love to spend their time on, is when is the Fed going to cut? How much is the Fed going to cut? What month are they going to cut? To me, that's not the important question or the important story. The important story is the tightening cycle is ending. And sometime in the next several months, they're going to start eating.
In this intricate mosaic of economic narratives, the silver market stands as a testament to the confluence of industrial demand and investment appeal. Silver's dual role not only fortifies its position in the commodity spectrum, but also highlights its sensitivity to a broad array of market dynamics. As we pivot towards an analysis of the silver market outlook, it becomes evident that understanding this metal's future requires a comprehensive appraisal of its industrial applications, alongside its traditional role as a store of value. The industrial demand for silver is a critical driver of its market outlook. Silver's unparalleled electrical conductivity, thermal conductivity, and reflectivity make it indispensable across various sectors, including electronics, solar energy, and medical applications. This industrial utility ensures a baseline demand for silver, providing a measure of stability to its price even amidst market volatility. As the global economy leans into green technologies and renewable energy, the demand for silver, particularly in photovoltaic cells for solar panels, is poised for growth. This burgeoning sector represents a significant opportunity for silver, with its usage in green technologies underscoring the metal's role in the transition to a more sustainable future. However, the investment appeal of silver, especially in the context of David Hunter's prediction of a market melt-up, followed by a correction, adds another layer of complexity to its market dynamics. The speculative interest in silver, fueled by expectations of monetary easing and a search for inflation hedges, can lead to significant price volatility. This speculative demand, while capable of driving prices to new heights, also introduces an element of unpredictability to the silver market. The balancing act between silver's industrial demand and its investment appeal is further complicated by global economic conditions. The strength of the dollar, geopolitical tensions, and shifts in monetary policy all play pivotal roles in shaping investor sentiment towards silver. A weaker dollar, for instance, makes silver more attractive to investors holding other currencies, potentially driving up its price. Conversely, an improvement in global economic stability or a shift towards more aggressive monetary tightening could temper investor enthusiasm for precious metals, including silver. In navigating the future of the silver market, investors and analysts must remain acutely aware of these dual forces at play. The challenge lies in discerning the relative impact of industrial demand versus speculative investment on silver's price trajectory. As we consider the potential for significant price movements, both upwards in response to investor interest and downwards as markets correct, the importance of a diversified and informed investment strategy becomes clear. As we explore the silver market outlook, what are your perspectives on the interplay between its industrial demand and investment appeal? How do you foresee global economic conditions influencing the future of silver? Share your insights and predictions in the comments below, enriching our collective understanding of this multifaceted market. For those seeking to delve deeper into the complexities of commodity markets and the factors driving investments in metals like silver, subscribing to our channel will provide you with a wealth of knowledge and analysis. Stay ahead of market trends and make informed decisions with our comprehensive coverage of the financial landscape.
I have probably the most bearish view on the dollar, and I've been watching it obviously for a while, closely. And I just think people are, you see it in the markets on a day-to-day basis. You get a little weakness in the dollar, and gold lifts its head. And I think technically the dollar, not necessarily in the next week or two, you could see the dollar. I see some signs that the dollar could bounce here one more time, but I think we're getting closer and closer to that point where the dollar is going to break back down. We've been in what I call a counter trend consolidation for a while. And people have been frustrated by the dollar staying up here so much. I just view it as it'll figure out when it wants to roll over, and when it does, it's going to roll over hard. So I think there's some sign of that. Certainly, technically, the gold breaking out and this time sustaining instead of being up there for an hour and then breaking down. I think people are, there's a lot of technicians following gold, or a lot of gold investors are technically oriented. So I think that's part of it. The chart looks great. I think that's all part of it. And basically, if you step away from the dollar and look at the other currencies that the dollar trades off of, and particularly Japan, the yen, there's a lot of signs that we're at a very big inflection point. No. The dollar downward, and these other currencies, including the euro, the yen, British pound, Canadian dollar, Aussie, I think they all look like they've got plenty of room to run on the upside. So, there may be people looking, at that. I do all of that in terms of trying to, I try to look at multiple markets and tie them in.
In our exploration of the financial saga surrounding silver, we traverse through economic cycles, monetary policies, and the dual nature of silver as both an industrial asset and a precious metal. As we approach the culmination of this narrative, it's essential to address the challenges and counter-arguments to the bullish outlook on silver, especially in light of David Hunter's prediction of a historic price surge past $3,026. While the forecast presents a compelling case for silver's potential ascent, driven by a combination of monetary easing, geopolitical tensions, and industrial demand, skepticism remains. Critics point to several factors that could temper silver's rally or introduce volatility into the market. 1. Technological advancements and substitution. One argument against the sustained rise in silver prices centers on technological advancements. Innovations in material science could lead to the development of cheaper alternatives to silver in industrial applications. If substitutes that perform equally well at a lower cost become available, silver's industrial demand could see a decline, impacting its price trajectory. 2. Global economic recovery and stability. The bullish case for silver partly rests on economic uncertainty and the appeal of precious metals as safe havens. However, a robust and sustained global economic recovery could dampen investor interest in silver as a hedge. If confidence in traditional financial instruments and currencies strengthens, the speculative demand driving silver prices upward may wane. 3. Volatility in investment demand. Silver's price is not only influenced by industrial demand, but also by investment demand, which can be highly volatile. Speculative interest in silver can lead to rapid price swings, making the market susceptible to corrections. While speculative demand can drive prices up, it can also lead to sharp declines if investor sentiment shifts quickly. 4. Impact of monetary policy normalization. While current predictions factor in the Federal Reserve's shift towards monetary easing, the long-term outlook could include a normalization of monetary policies. If interest rates rise in response to inflationary pressures or economic growth, the opportunity cost of holding non-yielding assets like silver could increase, potentially cooling investor enthusiasm. Despite these challenges, the case for silver's potential rally remains strong, especially considering its role in emerging technologies and renewable energy. The interplay between silver's industrial and investment demand, coupled with macroeconomic factors, suggests that while the road may be turbulent, the long-term outlook could still favor significant appreciation. As we reflect on the divergent paths silver's future could take, it's clear that navigating this market requires a nuanced understanding of both the opportunities and the risks involved. Whether silver will indeed experience the historic rally predicted depends on a complex array of factors, from global economic trends to technological advancements. What are your thoughts on the potential challenges to silver's bullish outlook? How do you assess the risk and opportunities in the silver market, given the current economic climate and technological landscape? Join the discussion below and share your insights on the future of silver investing. For ongoing analysis and insights into the silver market and broader financial trends, ensure you're subscribed to our channel. Stay informed with our comprehensive coverage, helping you navigate the complexities of the investment world.
It's treasuries, and that's all treasuries across the curve. So everything from T-bills out to the long bond, and obviously the longer the duration, meaning the longer the maturity, the probably the more appreciation you'll see if I'm right about rates. If rates fall in a deflationary bust to the extent I think they will, we'll have new lows on interest rates. I think the majority think that we saw the bottom in rates back in 2020. When we got to back in March 2020, when we got to 0.4 on the 10-year. I actually think, like I said, that we could go to 0 on the 10-year and negative rates on shorter rates. But it'll be short-lived, and then we'll start a very long bear market in bonds, long rise in rates over the balance of the decade. So, but during the bust, I think you get there. So all treasuries, I think, will hold up and actually, appreciate. And then I think the dollar, although I'm very bearish the dollar here and think, DXY can fall to 80, which is a huge drop from here. I do think during the bust, the dollar will get bid up as it always does during, global crisis. And I think you could see the dollar do a full retrace back to 120 from 80 and maybe even higher than that as people flee to safety. People around the world say, hey, yes, the U.S. had problems, but they have a lot less problems than the rest of us. So the dollar would be the second thing. And then, at least in the U.S., I tell people I believe the FDIC will be given any amount of money they need to meet their liability. So FDIC insured savings accounts will be safe, up to the limits of 250,000. So I think that will happen. Above that, not necessarily. Policies could be put in during the bust, both here and around the world, to protect the consumer and say we're going to do this temporarily, not break the buck on money market funds, et cetera. But we don't know that. And there's some resistance to doing that again, I think. But my guess is when push comes to shove, you're going to see the governments step in and do whatever they have to do to kind of prop up consumers and prop up the economy. But, I say global bust because I think it'll be worse than 2008-9. I think we're going to have a financial crisis unlike anything we've seen in the post-World War II era, meaning big bank failures, et cetera. And I do think central banks are going to be slow to just repeat they are convinced they made big mistakes back in 2020, and they're not going to be quick to want to just do QE and pump it up. Ultimately, as this is my thesis, ultimately, if you get a free-falling financial system, which is why I call it a bust, around the globe, there's only one policy tool that can stop that, and that's money like we've never seen before. So I'm predicting you could see 20 trillion come out of the Fed. So we did 5 trillion in the response to the pandemic. 2020 20 trillion would be 4 times that. Again, it's just my guess. I obviously don't know. And proportionally something similar to that around the world. So we would be seeing money like we've never seen, not even close. And of course, 2020 was like we had never seen. So I think they'll be slow to respond, but then when they realize this thing's falling apart and we better save it, you will see them panic in ways we've never seen before. So, it's again, if you were to sit any one of those governors down today, they would say, no way. There's not even a thought that they could do that. They're saying we want to do the opposite. We want to restore integrity to the system. We don't want to just blow it up again with more money. That's all great in theory, But when you're sitting in their shoes, and not just central banks, but also the governments, and you're watching a world about to just implode, you don't sit there and say, hey, in theory, this could cause inflation. You say, what do we have to do? Just like we saw in 2020, we saw programs we had never seen before because they're panicked. They said, we gotta save the system. So I think you'll see.
As we stand at the precipice of what could be one of the most pivotal moments in the financial markets, with silver at the heart of a historic melt-up, followed by an unprecedented bust, it's time to draw our conclusions. David Hunter's forecast, suggesting silver could skyrocket past the $3,026 mark, hinges on a nuanced interplay of global economic forces, monetary policies, and a shifting landscape of investor sentiment and industrial demand. This apex of our journey not only encapsulates the essence of Hunter's prediction, but also frames the broader context in which such a scenario might unfold. In the grand tapestry of financial markets, silver's potential ascent is emblematic of broader economic dynamics at play. The anticipated shift towards monetary easing by the Federal Reserve, marked by lower interest rates and a softer dollar, sets the stage for commodities, including silver, to shine. This policy pivot, aimed at buffering the economy against potential downturns, inadvertently elevates the appeal of non-yielding assets like silver, as traditional investments become less attractive in a low-interest rate environment. The geopolitical landscape, fraught with uncertainty and tensions, further compounds the allure of silver as a safe haven. As investors navigate through the murky waters of international conflicts, trade negotiations, and economic sanctions, the intrinsic value of silver, bolstered by its industrial applications and historical significance as a store of wealth, offers a semblance of stability and security. Yet it's the speculative fervor that could propel silver to unprecedented heights, driven by a collective anticipation of inflationary pressures and a surge in demand across both investment and industrial fronts. The growing focus on renewable energy and technological innovations, areas where silver plays a crucial role, adds a layer of fundamental demand to the equation, reinforcing the bullish case for silver. However, this journey is not without its turbulence. The challenges and counter-arguments, a potential for technological substitution, shifts in economic recovery trajectories, and the unpredictable nature of speculative demand, serve as reminders of the volatility and risks inherent in commodity markets. The path to Hunter's forecasted price point is fraught with uncertainties, where external factors and shifts in sentiment can dramatically alter market dynamics. In concluding this exploration, we're reminded of the importance of vigilance, diversification, and informed decision-making in the investment realm. Silver's story is far from linear. It's a narrative rich with potential, speculation, and risk, reflective of the broader complexities of the financial markets. As we wrap up this analysis, the call to action for investors is clear. Stay informed, remain adaptable, and approach the market with a balanced perspective. Whether silver reaches the heights predicted by Hunter or encounters unforeseen obstacles, the journey promises to be as enlightening as it is challenging. Thank you for joining us on this exploration. Don't forget to subscribe for more insights into the dynamics of financial markets, investment strategies, and the unfolding narrative of commodities like silver. Your engagement and curiosity are what drive us to delve deeper into these complex topics, offering clarity and perspective in an ever-changing financial landscape.